love him or hate him, Musk is really always been out there pushing the envelope on basically he does what people say can't be done.
Yeah, I'm kind of in your camp where put his politics or his person aside and just look at the outcomes he's created for society, making space exploration and communications more available to people. That's a societal good, in my opinion. What he's done with Tesla and making more efficient vehicles with less pollution, that's a big benefit too. And Musk actually has a AI firm that competes with Anthropic and OpenAI. They recently made news because they spun up data centers focused on AI using these high-end NVIDIA chips. And so he's definitely good at achieving what many people think isn't possible. Like the founder of NVIDIA, Jensen Huang, I think said no one else could have spun this server farm up but Elon, and he was able to achieve that.
I'm Garrett Wong, and this is the Investing to Win podcast. How do you define success, and what does winning look like for you? Mike, welcome to the podcast.
Hey, Garrett. Thanks for having me. How are you?
I'm doing really well. As we were saying, you guys are just coming off American Thanksgiving, so I know how it's trying to get the neurons firing again after all of the protein and starch I'm sure you ingested over the last few days.
Yeah, absolutely. It was a good break, but I'm happy to be back. Happy to talk with you too.
Awesome. So why don't we start by having you introduce yourself to the audience, and then we'll get into the topic at hand.
Yeah, well, thanks again for having me, Garrett. My name is Mike Ivancie, and I am currently head of marketing or CMO at alternative investment firm called Upmarket. And I've kind of had a lifelong passion for investing, and I've tried to sort of force myself to go into other rooms. And I sit down and I'm like, oh, I don't know if I really like where I am right now. And so I pursued a career in law and worked at Homeland Security. And then I had my own law practice. And then I switched careers and I got an MBA at Berkeley and sort of pivoted fully into financial marketing. And it's because really I have this kind of underlying obsession with investments and reading about the economy. I drive my wife crazy. It's what I read when I'm going to bed at night. My 4 and my 6-year-old have enacted a policy in our car that I could no longer listen to financial podcasts while I'm driving them to and from school.
4 and 6-year-old. Oh, Mike, Daddy, you're mean.
Yeah. Maybe I should try that for bedtime to help them fall asleep, but probably not in the car ride to and from school. But really, that passion was kind of created by my late grandfather, who would send me, article clippings, and my wife and I were reminiscing. He would call our house back when we had a voicemail, and hey, sport, I'm looking at, Mercado Libre. The broker recommended it. Let's talk about it. Call me back, sport. And sort of, this passion for this investing, I just haven't been able to shake. And I think maybe in a way for me, it's sort of connecting with my late grandfather and kind of honoring him. And I still have a bundle of clippings from IBD and, newspapers from him that he sent me. And I kind of reminisce and look at them from time to time. But lately, my focus has really been on private markets. With Upmarket, we sell alternative investments. And so really trying to understand what's happening in the private market space, what investors are interested in, and how we can sort of make it easier to access alternative investments.
Okay, let's dig into the background a little bit more because I love hearing pivot stories because I'm the master of the pivot. I was a scientist and I pivoted from there into real estate, but then I had a government scientist job for a while for 7 years and then shocked everybody when I pivoted then into be a realtor. So speak to me a little bit about law. So you went into law for, if you can remember that far back, for what purpose?
Yeah, I think, well, in undergrad, I studied criminology, and I was really fascinated kind of with human behavior and sort of how we put guardrails on that and how maybe that behavior gets to extremes. And I thought for a while that I wanted to do criminal law, so either prosecution or defense. And I interned at a public defender's office in San Francisco, and I prosecuted cases in Arizona, where I went to law school. And, I think I'm grateful that I did that legal education because it really helped me see that nothing is truly black and white. I mean, occasionally there are instances of that, but oftentimes you can make an eloquent argument, for both sides of an idea, and sort of I think that helped me appreciate nuance. But when the rubber hit the road as far as practicing law, especially criminal law, I found, I didn't really want to be defending, the really hardened criminals that have done something, that's kind of unspeakable. I fully respect the right to have representation and to, give people the best representation they can and fully defend their case, but it just wasn't for me. And then I also didn't really love prosecuting small cases. I didn't love the idea of prosecuting someone for a minor shoplifting or drug offense and having that totally change the trajectory of their life potentially, and kind of feeling responsible for that in some way. Um, and so that's kind of why I think I was initially drawn to law. And then I realized, I was at Homeland Security for about 4 years, and I loved my colleagues. I loved the people I worked with, but it was kind of bureaucratic. And my path since leaving there has been really small companies. I founded my own law practice, and I've worked at, two relatively small early stage startups. And I just love the idea of kind of getting your hands dirty and doing a bunch of different things, and not having kind of this burdening process. Because when I was with the government, I experienced, oh, hey, maybe we could do this a little more efficiently, or can we explore this idea? And it's just a non-starter conversation, unfortunately. And it felt like I was kind of a transaction cost more than really adding value. And that's not a place I like to be personally.
Yeah, I mean, not to put down government. I mean, look what's happening in my country and your country. I'm not That's as far as I'm going into politics, audience, but no, I mean, it truly is an oxymoron when you talk about efficiency and government. I mean, it was just from what I saw and your budgets and how people have to burn their budget or they get punished the next year and they don't get the same budget back. I mean, it's maddening.
Yeah, it really is. And I saw some of that firsthand. And sometimes it feels like, the obviously you have to provide due process when the government does anything in the United States. There's got to be due process before you take someone's liberties, or seize property or whatever it may be. But process sort of predominates, and then you lose the forest for the trees, and you're not focusing on outcomes for the American people, or for your agency necessarily. And it gets kind of wacky, I think. So yeah, I'm not going to delve into politics with you either, but I think we're probably in agreement on that one.
Yeah, no, for sure. All right. So you transitioned out, you did a pivot. Um, Maybe define for the audience and myself what an alternative investment is.
Yeah. So classically, I think you can think of the investment universe as, I think a lot of people think stocks and bonds. So maybe they're thinking Dow Jones or S&P 500 or the Nasdaq 100. These are indexes of some of the largest investments. These are publicly traded assets that are, easy to trade. They're liquid, very accessible to most folks. And then alternatives is kind of a catch-all or umbrella term, but really it's anything that is harder to access. Typically, we're talking about private investments. Real estate really, I think, is the most prominent one that you could fit into this alternative category. But private funds, private credit, private equity, venture. What Upmarket specializes in is kind of in between venture and private equity. It's kind of like a growth equity, is how a lot of people would label it, or how I would label it. It's also referred to as a secondary market, or some people say the pre-IPO market. And really, what that is um, alternative of investing in sort of proven later stage. So probably, typically when a small company raises capital, they go seed round, series A, B, C, D. The growth equity, or that kind of pre-IPO phase, is a company that's really proven its business model, is growing well, and maybe they're considering just staying private forever, or they have, their eyes on eventually going IPO and trading on one of these large exchanges. And so that's why some people call them pre-IPO investments. And examples of those would be companies like SpaceX or Stripe or OpenAI or ByteDance. Those are some of the biggest ones. And as far as upmarket selling alternative investments, we sell those uh, pre-IPO type of investments. We also sell hedge funds. And so hedge funds are another alternative where you're having a specialized manager that really knows probably one asset class or one really small detail within an asset class. That's their focus, and they're trading that. They've spent their career in, say, energy markets, for example, trading natural gas. That's their area of expertise. They set up a fund just to do that. And then the value you're getting there, and typically hedge funds are being invested in by pension funds or institutions. You're getting access to this asset class with this unique return profile that maybe doesn't match the S&P 500, and so they're not correlated, and that adds portfolio diversification. So if you're a teacher's pension in Canada, for example, maybe you're like, okay, we're overexposed to energy because Canada has a lot of natural resource stocks or a lot of natural resources. So we actually need to get exposure to tech companies. So we're going to go tap Silicon Valley VCs to invest in those funds. So that's kind of a basic overview of alternatives, which is outside of the traditional public market opportunities.
Okay. And before we talk about upmarket, it says in your bio, C note. Can you kind of explain what that is and how you grew it?
Yeah. So C Note, I started there. Gosh, when was it? I want to say 2017 or 2016, but it was a social impact investing firm. And for those not familiar, impact investing is this idea that you're making an investment and you're not just targeting financial returns for yourself, you're targeting some sort of positive social outcome too. And so the structure at C Note, we worked with these things called community development financial institutions, CDFIs. And in America, they're community banks focused generally on serving low income or underserved communities. And they're providing small business loans and also actually technical assistance is what they call it, which is basically like business coaching, helping, an example would be an entrepreneur of color starting their first business, helping them write their business plan, helping them get their first loan, helping them maybe negotiate or secure a lease for their business if they had a storefront. And so the mission at C Note really was to funnel capital into these community development financial institutions to generate financial returns, of course, but really the key focus there was kind of impact investing and generating a positive social outcome. So increasing employment or economic prosperity in these underserved communities.
Okay. And then from there, you transitioned to upmarket then?
Yeah. So it was late 2021. I felt like I had accomplished a lot of what I had wanted at C Note. We had kind of grown from a startup of four people, kind of wandering in the woods, looking to find product market fit. And then we pivoted. We started as a direct to consumer financial platform. Then we became more business focused. So we ended up signing big contracts to work with PayPal and MasterCard and a few other big firms and grew our assets. And I felt like I had left the company in a good place. And I got the opportunity to work at Upmarket, which is a little more focused on my personal passion, which is looking at individual companies, understanding kind of what's happening broadly in trends and the market, and really trying to educate people about what's happening in these alternative asset classes. And I've really enjoyed it. And so that's kind of why I took the opportunity to go to Upmarket.
Okay. And what's your official role at upmarket?
CMO or head of marketing.
And then in terms of like, let's dig into a little bit more about alternative investments. You mentioned real estate. So, I mean, walk me through what a client's experience would be at upmarket and how you would help them.
Yeah. So Upmarket's a broker dealer, and what we do is we try and go out and source opportunities that we think our investors want. And so we're always asking, is there something specific you're looking for? But we also have a pretty good idea. And then I've built out our website, and I get pretty high fidelity data on companies and things folks are interested in. But um, classically, someone would probably come across a market looking to invest in a company like SpaceX or OpenAI or even Airbnb before they IPO'd. That was an offering as well. And so these deals sort of move quickly because they all trade on a secondary market. And so the nice thing about a public exchange is like during exchange hours, there's always a willing buyer and a willing seller. It may not be at the price you want, but it's very easy to get liquidity and trade in and out. With these secondary market transactions, you have big institutions largely dominating the market. So venture capital funds, institutional investors, pensions funds, things like that. And they're buying big blocks of shares. So I actually have a slide I could show that might help sort of
Yeah, sure,
articulate
go for it.
and and I'll try and explain it for the folks that are listening as well. So what you see here is kind of the core of Upmarket's business. So in the example I have, there's kind of the way large investors tap the secondary markets. And so maybe you say a venture fund or an early investor, or even maybe a founder or an employee in a certain company has 50 million in shares they want to sell. Institutional investors can go pick up those blocks. Maybe they buy the whole 50 million. Maybe they buy, a $5 million chunk here and a $5 million chunk there. That's really not suitable to your typical investor. So in the United States, at least, Upmarket has investor qualifications. You have to be an accredited investor, have certain income or net worth requirements. But even so, it doesn't make sense for someone worth $10 million to put 5 million of that into one single investment. At least I don't think that's wise. And so what Upmarket is really doing is taking a $5 million chunk and breaking it up into 100 pieces so that 100 investors can then participate in, say, SpaceX or OpenAI. And then Upmarket is also sort of handling the investment process, because private investing, while our goal is to make it as simple and straightforward as trading in public equity, it's just not, because there's offering documents, there's these checks you have to do to make sure someone's eligible to invest. But we handle all of that directly on the online platform. And so one of my big things personally is that I think we should maximize access to the extent we can, and to the extent that it's responsible, and you're not, steering people towards, scammy or unscrupulous opportunities or extremely risky opportunities. And that's one of the reasons Upmarket focuses on these later stage companies that are more proven, because early stage venture is kind of, lick your finger, point it in the air and try and guess which way the wind is blowing. But usually, typically, not always, these later stage companies, they're very established, they have strong income, they have strong growth levers they can pull on. And so the business isn't going to, pivot from Stripe isn't going to pivot at this point from being a payments processing platform to, being an e-commerce, like Shopify competitor. They already have their business model set. And so really the value a platform like Upmarket, and there's a lot of them, and I think competition is a good thing because it'll lower fees and increase access over time. Really what these platforms are doing is just making these investments more accessible to individual investors. And then, you know, the examples I'm sharing here on the screen now are kind of past examples of investments that we've offered folks, OpenAI, SpaceX, Databricks, ByteDance, Anthropic, things like that. And just trying to make that experience entirely online. So no wet signatures, you're not faxing or mailing documents back and forth. You're doing everything online. You're getting regular updates from fund management, administration, all of that is kind of handled for you to really simplify the process.
So, Mike, when you were talking about upmarket and things like that, I mean, what is the experience? So you're talking about alternative investments, but what I'm thinking of course, is the stockbroker traditional type of, I guess, a traditional type of investments. How does that experience differ or even compare to what your company is offering?
Yeah. So Upmarket is a regulated broker dealer, but there's some big differences between Upmarket's offering and kind of the traditional experience with, say, Robinhood or E-Trade or brokers like that. Obviously, first is the kind of asset class you're trading. Robinhood, these other platforms, you're only going to be able to access generally, publicly traded equities or debt, things of that nature, maybe Robinhood crypto. But really, I would say it's focused. So these broker dealers are focused on providing a full universe of assets. And actually, some of them, like JP Morgan's and Morgan Stanley's of the world, actually have alternative investment offerings. However, those are only going to be available to their highest net worth clients, the private wealth clients of the world. Every platform is different, but typically you're looking at having, liquid net worth, maybe 5, 10, 25 million to have a private wealth uh, contact and to be a private wealth banking client. And so the difference is upmarket is focused solely on these alternative investments. We don't sell public equities, we don't trade public equities. It's just an extreme amount of focus. But when it comes to the investment experience, there's a lot of similarities where, you have a dashboard, you can log in, you can see all of your investments. The investments aren't marked to market on a daily basis like public equities, private markets. I think I said earlier, the true value of your private investment, in my opinion, isn't realized until you sell or have a liquidity event. If it IPOs and then it's publicly trading, you know exactly what it's worth, or if you sell it, you know what it's worth. But we're providing quarterly marks and quarterly updates on the status of your investment and taking care of tax documentation. Some of these investments require for US investors at least a K1, which is a tax reporting document. And so, as far as the investment experience, we're trying to make it as smooth and streamlined as possible. Our ultimate goal being it feels essentially like trading public stocks. Obviously, we're not there. There's a lot of innovation that has to happen in the marketplace, but that's really our goal and principle. So it's similar. It'll be sort of native or natural feeling to a lot of investors, but obviously the quirks of private investments not being marked to market daily, not being easy to trade in and out of, that'll be reflected in the user experience.
Yeah, I mean, thanks for that. I think a follow up question that I might have is when you're talking about alternative versus traditional, you said high net worth in a stock uh, broker versus obviously you're able to cater to the quote unquote little guy. Why would a traditional firm only offer alternative investments to somebody of ultra high net worth?
Yeah. Well, part of that is regulatory, and then I think part of that is a business decision. But in the US, there's requirements to invest in certain types of assets like these, like non-registered securities, where you have to be an accredited investor. And it depends on if you're married or single, but typically it's a certain income level, 250,000 or 300,000 a year, or a certain liquid net worth that you have to have, not including your primary residence. And upmarkets beholden to that criteria as well. So we can only work with accredited or qualified investors. And I think these brokerage houses have sort of decided, it's a lot of work to go out and source opportunities and in private markets, and we're going to reserve that for our highest net worth clientele. These are the kind of people that have founded companies or really have extreme net worth, and they're maybe borrowing, taking loans against their equity holdings, and they're doing, bespoke financing to purchase homes and things like that. And so they've sort of made a business decision. We're going to provide this suite of offerings only to the most wealthy clients. Certainly they could, figure out who is accredited and offer those sort of private investments, but at least the trend so far, and I would welcome it if they did. I think having more access would be great, but generally, to really tap into alternative investments like this, like hedge fund investments or these growth equity or pre-IPO investments, you have to be a really high net worth investor for the traditional brokerage houses. And so what makes Upmarket unique is we're only doing these alternative investments, and we're serving anyone who's an accredited investor that qualifies under the regulations, whether that's, we've worked with Canadian investors, international investors, but obviously predominantly US investors, and whoever's eligible and meets those criteria, we're happy to work with.
Okay. So when you talk about an alternative investment, and I'm just going to pick on real estate because that's what I'm in, what does that look like on your end? I mean, like, or maybe even, I don't think we exactly covered it because I asked you what does a typical transaction look like. But if somebody comes to you, they're accredited, and that they have, let's say, I don't know, 300K that they want to put into something, and you probably have some kind of interview process. What are your risk tolerances? And they're like, I'd really like to put something into real estate. Walk me through how that looks.
Yeah. So generally, the approach is we're not necessarily recommending investments to clients. We're sort of making our suite of offerings available, but we're definitely listening to investors. And if there's strong demand for real estate, we would do that. And so we've had some real estate funds that we've offered in the past. What that looks like on our end is these are, a real estate fund where there's a professional manager, maybe a construction project, or an example, we had some student housing funds recently. And so they're, buying or constructing a large apartment building near a university. And they've kind of, they can figure out occupancy and they know that there's going to be strong demand because the university is performing well. But the nuts and bolts of that is an investor comes to us with 300K and says, I'm looking to, diversify my portfolio. And then really it's sharing the opportunities that are available and then letting them sort of guide their own journey within guardrails. Cause we're always asking our investors their suitability, suitability questions we have to ask investors, like what is your liquidity preference? Um, what is your exposure to other assets? Because you really don't want to be investing in, say, a pre-IPO investment like SpaceX. Even a lot of people think SpaceX is a great investment, but you may not realize gains on that investment for years because SpaceX could stay private. And if you don't want to transact in the private market and sell your shares and you bought that waiting to IPO, it doesn't make sense for an 80-year-old person that may need liquidity within 12 months to buy that. And so that's a conversation we're definitely having with investors and having them fill out questionnaires, kind of understand what products may be a better fit for them versus others. Um, and so, as long as the suitability generally matches with the product, I think it's up to the customer to decide. But the extreme case I'm sharing with you, an 85-year-old person investing in something with a 10-year horizon, or
Right.
someone, they have young kids going to college soon, you're going to need that liquidity. So maybe rather than a pre IPO investment where the lockup is sort of uncertain and you don't necessarily know when an IPO is going to happen, maybe something like a real estate investment or a hedge fund where, there's a 12-month lockup and you can get quarterly liquidity on 30 days notice before the quarter end, that would be a much more appropriate investment. And it's just really a case by case basis from there.
For real estate, though, I mean, are you guys taking somebody's direction and putting that into a syndication as more of an institutional, like then you become the institutional investor? Or, I mean, how does that work?
It's more going out and sourcing opportunities that we think our clients would be interested in and then bringing to them and then letting them give us a yay or
I
nay on
see.
it. And
Okay.
so an example would be like maybe an EB-5 visa program where the US government has a program where if you make a certain amount of capital investment, it creates a certain number of jobs, it may qualify you for a visa. And so for some investors, that may be worthwhile and interesting. And so for others, like myself, I wouldn't have interest in that, but we're presenting deals like that. The student housing one, sort of an income generating, kind of longer term, hopefully investment that you could capitalize at some point in the future if you wanted. But we're not necessarily going out and structuring deals and originating them and acting as a manager. It's more sourcing opportunities we see in the marketplace that look interesting, based on sort of larger trends we're seeing and things like that. Like hedge fund, for example, would be, we think there's a strong thesis around energy, which maybe we can talk about later related to AI. Well, perhaps offering our investors hedge funds that trade and specialize in energy and natural gas markets would be a way for them to get exposure to this sub theme while adding diversification to their portfolio.
Okay. You mentioned pre-IPO. Maybe break that down on a very basic level again for me as well, but for our listeners who are really here to learn. When I mean, let me give some context to my question. If How hard is it for somebody to invest into pre-IPO, and then obviously upmarket gives you that context and opportunity, and then maybe explain first what pre-IPO is and why it's advantageous to get in at that point.
Yeah. So pre-IPO to me is kind of like this vague term, but really, like I said before, it's probably Series C or D or greater, later stage companies that have kind of proven their business model. They have the potential to go public, or maybe they even meet a lot of the criteria to go public already. And then I think the reason these opportunities are so interesting right now, and I have some slides I'd love to share, is the pre-IPO market actually largely closed recently. 2021. I'm going to share,
Yeah, throw those up.
yeah, share this slide with you. So this is the number of IPOs in the United States over the last few years, going back to 2000. You can see 2021 was obviously a banner year, quite a unique year with a lot of liquidity and things flooding the markets. But since then, IPOs have been depressed. And what's happened is it's created this backlog. And so for people listening, in 2021, there were 1,035 IPOs in the United States. And then in 2022, there were only 181. 2023, only 154 or so. And um, those are quite depressed numbers when you look back and see, 200 to 300 for most of the 2010 through 2019 period. And so what's that created is that there's a backlog of unicorns, and unicorns are just venture-backed companies valued at $1 billion or more. Um, and so you have this growth of unicorns, and the chart I'm showing now shows, in 2014 there were probably less than 200 unicorns, and now in 2023 and onward, there's over 1,200 unicorns, and these are private venture-backed companies that uh, aren't necessarily IPOing, but these people that have invested in these companies, venture funds, employees, they want liquidity, right? They're a large chunk of their net worth is tied up in these shares, and they want to unlock that value. And if these companies aren't publicly traded, they have to go somewhere else to do that. And what they do is they go to the secondaries market, which is kind of this pre-IPO market we're talking about. The chart I'm showing now, the total tech IPO value in for 2023 through 2024 is like around 12 or so billion. But the total amount of secondaries, these are private offerings that companies like Stripe, Databricks, CoreWeave, Figma, and others have traded, is like around 18 billion. So actually, the secondaries market has now grown, at least in recent time, to be larger than the tech IPO market. And this chart is from The Information, which is a great publication that covers a lot of these high growth kind of pre-IPO type of companies. And so really what Upmarket is trying to help people do is tap into the secondaries market, which is sort of growing because of this IPO window being limited and the backlog of these unicorn companies and the need for investors. A lot of venture funds operate, maybe they have a 10-year horizon. And so once that fund reaches 10 years of life, the investors or the LPs, the limited partners in that fund, are going to want to get capital back. If those companies haven't IPO'd or had a liquidity event, where they're purchased through M&A activity, then they have to go to the secondary market essentially to unlock some of that capital. And it's kind of like this new asset class in a way. I mean, it's not new, but it's more of an in vogue asset class because you have these sort of proven companies like Stripe and Databricks, definitely well respected, regarded companies. Figma was acquired, and then I believe regulators overturned that acquisition. All proven strong companies, but for whatever reason, they're not tapping the IPO market yet. But they need liquidity, and there's opportunity to purchase shares either in anticipation of IPO or future appreciation, additional private rounds for that company. And so that's kind of the mega theme that I see around why pre-IPO investing is getting in vogue, and people are more interested in it because there's a lot of really valuable companies in this sort of, I don't want to say purgatory, but it feels like purgatory between being like an early stage venture company and going to IPO. And I have some historical data here that shows the number of IPOs per year. This is a really interesting data from the Warrington College of Business at University of Florida, but they look at the number of IPOs and the median IPO, and IPOs have seemingly gotten larger and less frequent. You look at the 1995 data, the average IPO size is 445 million. And then you fast forward to, 2020, 2021, almost 4 billion, 3 billion, 3.5 billion, more recently, 1.7 billion. And so these companies are staying private longer. And what that means to me is that a lot of the value that these companies are generating is accruing in this private stage. And this is a sort of a really extreme example. So definitely take this with a grain of salt. But I'm sharing a chart now that shows Amazon, which we all know, it IPO'd back in May of 1997 at a $438 million market cap. Fast forward, what is it, 25 years or more later, now it's trading at a $2.2 trillion market cap. Uber is more representative of kind of the modern IPO approach. It IPO'd at $69 billion. So that means those early stage investors that invested, in seed and all of that received a ton of value. And then it IPOs at 69 billion, and now it's currently trading at 152 billion. And so it's just the accrual of value and growth seems to be happening a lot more in the private stages of the company right now. And that's kind of the overarching thesis or idea why I think investors are excited about accessing private markets, these kind of pre-IPO or growth equity companies, because there's the opportunity to accrue a lot of value in those stages.
Well, and you said it. I mean, maybe you can go back, or just if you have that number off the top of your head, you gave a stat with the current number of pre-IPO companies versus however many years ago, and it was staggering. I mean, it was four figures versus two or three figures, wasn't it? Didn't you say, repeat
Well,
that
yeah.
for
So,
us?
like the number of unicorns that exist,
Yes,
it's gone.
unicorns. Yes.
Yeah, it's gone. In 2014, probably under 200 to now well over 1,200, closer to 1,600 companies, and that's 4.5 trillion in value of those companies. That's sitting and it's traded generally privately, um, and it's not accessible to public market investors.
Now, in terms of the unicorns and the sheer number, is that indicative of the trend that the companies themselves want to stay under that IPO level for longer due to either growth or a bigger payout at the end? Like, what's driving the amount of unicorns in the market now compared to 25 years ago?
Yeah, I was thinking about this a fair amount, recently and before our call today, Garrett. And I think, one big factor in my mind is that venture capital as an asset class has matured, I think, quite a bit. Um, the Amazon example, going IPO at $400 million valuation, that's relatively low, even adjusting for inflation, which would be like a $900 billion valuation. I think what's happened is the size of the checks these venture firms can write has grown a lot. And I think also a lot of these companies are saying, well, I can get all the funding I need on the venture side, or maybe even venture is encouraging them to take these large checks because you have a lot of institutional investors and pensions funds that might be saying, well, I want to get a lot of exposure. If I'm a $1 trillion pension fund and I need, you know, 5 or 10% exposure to venture capital to build a portfolio, that's a lot of money that one pension fund is deploying to an asset class. And you multiply that by a lot of pension funds, well, then venture firms have a lot of capital to play with. And so, the amount of capital flowing into these companies and the size of the rounds they're raising, the valuations they're raising naturally grows. And I think with that, a lot of companies say earlier where the number of IPOs has declined significantly, it's because, public markets and markets in general are very kind of psychological, emotional driven. And if you feel like you're going to IPO into a really bad market, it might hurt your company long term or hurt the short term valuation. And there's also a lot of more regulatory burden being a public company versus a private company. And so I really, to answer your question, I think it's partly regulatory, but I really think it's the maturation of this kind of asset class, venture capital, the amount of flows into that. Because you look at the Airbnbs and the Ubers and all of that, it's pretty clear that there was a lot of value created for the early investors in those companies. And I think if you're at a pension fund or an institutional investor, you're answering to your LPs if you're not accessing an asset class that has really outperformed. Obviously, investors that deploy capital at the peak of 2021 are probably disappointed with their returns, but overall, I think there's been a lot of strong performance, which has drawn just more capital into that space.
What about private equity? I mean, you did mention PE, I think very briefly at the beginning. Is that something that you guys delve into?
Yeah, we offer a few private equity funds, and that's kind of in our ethos of trying to. Our goal really is to help people build diversified portfolios. Like, there's no expectation that someone should build a portfolio of all their assets on upmarket. And I think that would actually be short sighted and not a great idea to do that. The idea is, okay, I've got, my holdings. Maybe I'm invested in low fee index funds in my brokerage account, and I've got 60% of my portfolio there, and I want to take 5 or 10 or 20% of my portfolio, maybe put 5% in a PE fund, 10% in IPO companies that I believe are making the technology of the future, and build a more diversified portfolio doing that. But private equity is definitely something we've offered clients in the past, and we will continue to offer, especially as the appetite grows for that.
Yeah, no, PE is something that I think I mentioned I was at the business conference last week. And I mean, I'm interested in it more as a small company that's trying to get into the PE space by doing like home services roll ups and things like that. Like, when we're talking about the platform company and bolting on some portfolio companies to get your EBITDA maybe over 10 million, where you start to attract, the lower level PEs, where then you can get these multiples, right? And these very lucrative, either you stay in or, lucrative payouts. So from what you're saying is that's kind of like an alternative alternatives, maybe not the right word because you're already in alternative, but a different option that you believe is good for diversification.
Yeah, I think, ultimately it comes down to the management and then the strategy and how that fits into your portfolio kind of construction, because everyone has their own objectives and time horizons and risk tolerances. And for some, private equity is very attractive. For others, I think that as much as been said that's positive about private equity, a lot of people have very strong feelings negative about the asset class. I don't think it should, don't throw the baby out with the bathwater. I think there's a lot of interesting opportunities and mispricings and things that private equity has been able to take advantage of. It's just finding the asset and the strategy that really makes sense for your individual goals.
No, I would tend to agree. And that, I mean, the reason I mentioned home services, and this is a really good segue into what you mentioned that we might have time to talk about, is AI, right? How is AI disrupting some of these industries? For me, I like home services like HVAC, plumbing, and electrical because they can be enhanced by AI, but I don't believe they're going to be killed by AI. Do you want to maybe touch on some of that and what you're seeing in trends?
Yeah. So I think one of the questions you had mentioned before we started talking was kind of trends we're seeing broadly in investing, and like what our market investors are interested in. Um, and I can tell you, the biggest interest has been around OpenAI, SpaceX, Anthropic, which is a competitor to OpenAI, and then SpaceX slash Starlink. Starlink is a wholly owned subsidiary of SpaceX, but it's kind of this immaculate business or really impressive business on its own right, because it's uh, competing as an internet service provider globally. And so those companies have been of great interest to our investors. And I get kind of high fidelity data on people coming in and visiting our website and researching these companies. And I can see, those are definitely the top ones.
Actually, Mike,
Uh,
I'm just going to have you define, because a lot of people hear OpenAI and they're like, okay, what is that?
yeah.
I mean, we're talking ChatGPT, right? Yeah,
Yeah.
okay. And then SpaceX is
Yeah, so SpaceX is the Elon Musk rocket company, and they recently made headlines. They launched their Starship rocket and tested that, and then the booster returned to Earth and kind of magically was caught,
that. Well, yeah,
but
it's
yeah.
unbelievable. I watched that video about 10 times because I thought it was in reverse. But
Yeah, and so SpaceX is a really interesting company because you have this rocket business where they're delivering payloads to space, also delivering astronauts. I think they aided. There was a capsule issue, I think, with a different manufacturer had made a capsule and it failed on the International Space Station, and SpaceX was supporting and bringing those folks back. And then SpaceX just had their first manned spacewalk recently as well. But within SpaceX, they've been launching, SpaceX's like kind of killer feature is their reusable rockets. So we've all seen the videos of those rockets landing and then the booster being caught. But the idea is they can land these rockets, quickly refill them, and then launch them again. And it greatly reduces the cost to deliver payloads to space. And so knowing that, SpaceX created Starlink, which was this business within SpaceX to launch communication satellites into space. And they have a whole constellation of these satellites now. And it's hard not to read about Starlink. Anytime there's a natural disaster and internet service is disrupted, those Starlink terminals are typically being delivered to those areas so people have connectivity to, connect with family members, maybe get federal aid services and things like that. And Starlink recently signed a big contract with United Airlines, and now they're providing the in-flight Wi-Fi on a lot of airlines. I think Qatar Airlines, United Airlines, and others. Uh, so it's a really interesting business. And then just to kind of reiterate what you're saying about OpenAI, I think it was around 2 years ago now that OpenAI launched ChatGPT,
yep.
and it was the fastest growing consumer app. I think it beat TikTok and Instagram as far as reaching a million users the fastest. And what they do is they're a research firm dedicated to building large language models, which can help with reasoning tasks and completing reviewing documents, completing writing projects, all kinds of things. And Anthropic is another firm that's kind of a direct competitor to OpenAI, and they provide the same services.
Yeah. So we're talking about disruptors, right?
Yeah.
Disruptors. And in terms of, I mean, we started this conversation off by saying, what you like to see and starting to invest in. Um, yeah, I just find it fascinating. You mentioned those in particular because those are kind of on the forefront. You know, love him or hate him, Musk is really always been out there pushing the envelope on. Basically, he does what people say can't be done, right? I
Yeah.
mean, it's
Yeah.
like,
Yeah. I'm kind of in your camp where put his politics or his person aside and just look at the outcomes he's created for society, making space exploration and communications more available to people. That's a societal good, in my opinion. The what he's done with Tesla and making, more efficient vehicles with less pollution. That's a big benefit too. And Musk actually has a AI firm that competes with Anthropic and OpenAI called XAI. They recently made news because they spun up one of the largest clusters or data centers focused on AI using these high end NVIDIA uh, chips. And they have like the largest server that does AI right now, or at least as publication a few months ago, and there's plans to grow it. And so he's definitely good at achieving what many people think isn't possible. Like the founder of NVIDIA, Jensen Huang, I think said like no one else could have spun this server farm up but Elon, and he was able to achieve that.
Yeah, no, it's like a sci-fi movie. Every single day you read something. Um, let's talk briefly before we end. Just advice, right? Aspiring investors. There's anybody who wants to diversify into this private market, overwhelmed. Like, what advice are you going to give them?
Yeah. Um, so I think the most important thing is that these alternatives and secondaries market, it's just not for everyone. Like, I think the way people should be approaching it is I'm trying to construct a portfolio, and tactically, I need access to XYZ asset because that's going to help me build a better portfolio. And so the things I would consider, the number one is liquidity. And we kind of talked about this before. Private market investments, the ability to exit is going to be much more limited than public market, right? Regular trading hours, public market, you can exit a trade, whenever you want. It'll be liquid. It may not be at the exact price you want, but it'll be easy to dissolve that position. For private investments, what Upmarket is doing, and I shared that graphic earlier of these block trades and us breaking these blocks up. We're going out to funds and managers, and we're sourcing these opportunities. So it's kind of harkens back to like the old school idea of like kind of a call out and a pit, but even less sophisticated than that, where it's kind of you have to have connections in the industry and you have to be able to source them. And that is true for buying, but that's also true for selling. And we help our clients do, trades if they need liquidity, but it's not something I think you should plan on. You should enter an investment sort of expecting, the time horizon on this is indefinite. And if I need liquidity on this investment, I shouldn't put the money I need liquid in that kind of investment. The second thing is risk tolerance. A lot of these high growth kind of companies that people are really interested in are going to be high beta, which means they're going to move alongside the market generally. And that's why the IPO window is closed, because we kind of went through this bear market in 2022. Um, no one wants to IPO into that kind of market because it's a headwind for asset prices. And so you if you invested in some of these private opportunities at that 2021 peak, it's going to be hard to claw back from that. So you have to have some drawdown and risk tolerance. A lot of those companies are bouncing back and perhaps reaching new highs, but there was kind of a valley that some investors had to go through. I think another thing, excuse me, another thing people need to consider is like, where am I in the cycle, the business cycle? What are interest rate policy? Where's that headed? And, you as a real estate investor, I'm sure are very attuned to that, is like, your where interest rates are now versus where they're going to be in 2 years is going to affect your cap rate, your exit multiple, all of that, and how you can capitalize these investments. So you got to have a good view on where we are in the cycle and if that makes a lot of sense for these investments. And I would say too, if you can find the return profile or asset class you're looking for within the public markets, excuse me, where there's greater liquidity, go there. Like, you should only tap the private markets when there's a unique strategy or a unique company that you want to invest in. And there's no way to replicate that with a public market comp.
Sure.
Um, Another thing I think a lot about, and I'll give you a personal example. I recently invested in this company called Anduril through Upmarket. Anduril is a defense contractor. They make drones, communications devices, really weapons of war for US and allies. And when I was looking at that investment, I think we sold that investment around a $16 billion valuation. So that's a pretty valuable company. Not anywhere near like SpaceX, which I think is around 250 billion. But ask yourself, okay, what is the valuation I'm entering at? And can I make up kind of pro forma scenarios of plausible exits? Like, what is my downside scenario? What's the upside scenario? And one thing I like to do that's very simple and kind of reductive, but play the market cap game, which is I look at a company like Anduril, very early stage still. What are the public comps? Maybe it's a Lockheed Martin, maybe it's a Boeing. what's the revenue of those companies? What is the market cap of those companies? Do I think this disruptor company can reach those stages? And if so, is that a valuation I think it can grow into? Um, Finally, I think understanding fees and the total return of private market investments, because you know there are more fees associated with tapping the private markets. Typically, a private investment, when you subscribe or invest, you're going to pay a subscription fee, which is a percentage of your total investment. You're also going to pay an annual management fee, which can vary, but it's typically 1% of your investment annually to sort of administer the fund, to take care of tax reporting, all of that. And then oftentimes there's a carry associated. So carried interest, or carry, is basically the idea that when you exit that investment, the manager or the person you bought this investment from takes 10-20% of whatever gains on that investment. So if you invest $10, turns to 20, and there's 20% carry, that $10 in profit, $2 goes away as fees. And so you need to look at all these fees and really think about, okay, if my total hold time is 10 or 15 years, how much am I paying in management fees? What is the carry going to look like? And I think a lot of investors should really, I mean, I'm given a long list, but I think it's really important to go in eyes wide open to these things. The last thing we would want is investor to feel like, wow, I wasn't expecting to have all these fees, but it's sort of industry standard, like,
Right.
subscription fee, 1 to 3%, annual management fee, and then carried interest. And so you have to factor that into your investment too. I think for a lot of investors, they're willing to pay that because if you want to access OpenAI or SpaceX, there's really no other way. And it's kind of the cost of doing business.
Yeah, no, that's a great summary. I think the lesson really is eyes wide open, know what you're investing in, and know that when we're talking about alternative markets, like it truly is alternative. So don't just go, gangbusters and just go all into it, right? It's an opportunity that has to be carefully vetted because I mean you're giving an alternative opportunity to investors that they wouldn't have normally had. I mean, who can say that they can invest in SpaceX or OpenAI? And of course, there has to be a cost to that.
Yeah, absolutely.
Okay, so I like to cap off the episode by always asking the same question, and I want to hear what you have to say, especially as an investment guy with a 4 and 6 year old who I hope will be listening to this episode in the car one day. But Mike, this is the Investing to Win podcast. How do you define success, and what does winning look like for you?
Yeah. I love this question. I listened to a few other of your episodes before we chatted. I think for me, uh, investing to win is about freedom, um, giving you the freedom to spend your time doing what you want to do. Um, so many people, I think, especially in Silicon Valley, I live proximately to, I'm in the Bay Area. They see kind of stacking numbers as the end result of the game. But then you wake up one day and you have a lot of money, but maybe you're poor in other facets of your life. And my grandfather, going back to him, who's kind of my inspiration for this, he always said money should be a tool to allow you to do what you want to do. And I see winning and being successful investing about giving you the opportunity to spend time doing what you're doing, whether that's coaching your kids' little league game or, volunteering or donating your time to something more important. I definitely do not mean just sitting on a beach drinking margaritas. I think if we're being intellectually honest with ourselves, I think most of us, probably you included, Garrett, knowing all the things that you've done, you wouldn't be happy. That would last like 1 week and you'd be like, all right, what am I doing now? What, this is just not enough for me. And I think, uh, if if invested well, you can live a rich life, not financially, but everything else. And money should open doors for you to live the life you want to live and not have to think about money, really. I don't think money should be the end result or the goal. Money should be a tool to let you do what you really want to do and pursue your passions.
Yeah, I love that, Mike, because for those of you who say money can't buy everything, I agree, but I am in the camp that thinks that money can buy time. And I mean that is really time is the commodity that we run out of, right? And and those loved ones. So that's a great point to end. Thank you so much for coming here and spending the afternoon with me. I thought it was a really good discussion. I learned a ton, and I know our listeners did as well.
Yeah, thanks for having me, Garrett. Great meeting you and great chatting with you today.
All right, take care.